All right, what's up, guys? I hope you're doing well. James here from jamesdforsythe.com. Again, going over another speech. This one is by Governor Michelle W. Bowman, Fed governor, about the outlook of for inflation and monetary policy. Right, kind of giving. It's not very long. So, and this was taken. Um, this speech was given June 23rd. So that's about 3 weeks ago, somewhere around there. Right. So a few weeks ago, and it was given at the Officers Conference, which is for the Massachusetts Bankers Association. Excuse me, right? So with that being said, we're gonna go ahead straight over to the screen share because she talks about like how like the labor market and all of that is kind of affecting it, so to speak. And I'll make sure to change screens so hopefully it's larger for you guys and you can see it too. Instead of just listening to me talk. So inflation is the highest we have seen in the United States in 40 years, and so far it shows little sign of moderating. This is especially because keep in mind, I specifically said this date when it was given was June 23rd, so that was before June's CPI print was taken out or was given out or published. I mean, and I think I saw it come out at 9.1 for June. I think off the top of my head without having it right in front of me because I think it came out like today or yesterday or something. I don't know. But recently it's got a 9 handle on it, I'm pretty sure. So it's definitely not moderating anymore or at all. So at the same time, the economy is growing at a moderate pace, which I thought was kind of confusing considering that I'm pretty sure Q1 had a negative GDP print. And then, I mean, obviously Q2 hasn't come out yet because it's only a little over 2 weeks before that came out, or at least I haven't seen it yet. And last time I looked, what was it? What did they call it? The Atlanta Fed's, I think it's called GDP Now, was projecting negative GDP for Q2, which would be two consecutive GDPs, which is technically a recession, right? So I don't understand how we're growing at a moderate pace when GDP is contracting. Maybe there's some other metric that I'm just not considering at the moment that she's alluding to, but I don't know. So the labor market is extremely tight, as indicated by a variety of measures, including reports of many employers unable to find workers despite significantly wages, raising wages. So that tightness is contributing to inflation because labor is the largest input cost for producing goods and providing services, right? So essentially, maybe not intentionally, but kind of blaming at least part of inflation on labor, right? So wage inflation. I mean, you increase people's wages, you increase the amount of disposable income, or hopefully disposable income, I should say. And even worse, if they have to increase it just for them to pay their living expenses, right? Because then that's a non-negotiable. It's like you have to pay that anyway. And so it's not like it's getting saved. That means like all of the increases are just kind of being compounded by continuously getting put into goods and services, creating more inflation, right? So, and that's one thing you have to keep in mind. So, to continue talking about what they really care about, so near term inflation expectations tend to rise as current inflation increases, but when inflation expectations over the longer term, the next 5 to 10 years per se, begin to rise, it may indicate that consumers and businesses have less confidence in the Fed's ability to address higher inflation and return it to the FOMC's goal of 2%. Right, and so it's kind of have this 2% goal for CPI, as usual. Even though I think the 2% goal is specifically for CPI because that's what people normally look at. But I know from their perspective, they really care more about PCE because the basket of goods and services is weighted differently. It's PCE is the oh god personal consumption, personal consumer expenditures. And there's so many acronyms, and for some reason, I'm just going blank on what the exact specific words they're using for all of them are, because some of them can be similar. Like I just wrote a post for financial stability, so it's like there's the FSB, there's the FSOC, and then there's a lot of alphabet soup in this kind of stuff, so forgive me for getting stuff or misspeaking or whatever the exact acronym stands for, right? So as she mentioned above earlier, so one force driving inflation is extremely tight labor market described above. So she goes on about some of the gains that we've had, and I will have to look again at the jobs report because I don't remember it off the top of my head. But and I think I did a video on the jobs being created in the past year, and essentially in some industries, I believe most of them, at least how they categorize the economy in different industries. I think there were only a few of them actually got back to their 2019 levels, right? And so it's like we're talking about all this job creation, but we're not even back to pre-pandemic levels. And I could be slightly wrong on that, but the general premise I believe is true if I remember correctly from the previous video. I'll see if I can find that and link it in there, um, so you guys can look at it too. But to continue, even with these gains, wages have not kept pace with inflation. They never do, which has made it much more difficult for many workers to make ends meet in the face of soaring housing, energy, and food costs. You know, not talking about housing, but like energy and food. It's like how that's. I mean, personally too, that's the ones that are making it worse for me, at least, or at least had a larger impact because one, they're non-negotiable. I mean, you need energy and food. Um, but they're excluded from core CPI. So it's like, what the hell? um, anyways, to continue, so in addition, the tightness of the labor market is exacerbated by a labor force participation rate that remains far below the pre-pandemic benchmark, representing millions of workers sitting on the sideline. Starts talking about like retirees and how during the pandemic they were incentivized to just retire, which I don't particularly blame them when you see all that stuff happening, especially when at the time, especially in the very beginning, at least mainstream, we didn't have any idea of really what was going on. I'm talking about very beginning, and so from their point of view, I don't blame them. Like I'm 60, pretending I'm 62, and be like, do I really want to deal with this for 3 years? Like I don't blame that decision at all. Um, Also, family caregiving stuff, fair enough. I've also talked to some people personally who, I mean, they quit their job because of asset prices going through the roof. And so that is also a factor, but not stated. But to what degree and how that's relative to, or to compare that to these other factors that are listed, I don't know. I haven't seen any data on that specifically. That part's more purely anecdotal, right? I know on, I believe it was a recent Macro Voices podcast. Eric Townsend was talking about some person he knows. I forget what the exact relationship was. Um, and I believe it's Macro Voices. I could be wrong too. Um, but they were talking about like how they were a restaurant owner and a lot of their employees left specifically because of asset prices increasing so much. So like, why would I wait tables? And now with especially the crypto crash, then they're all coming back for work. So that could also be a factor as well, right? And so what are they going to do about it with inflation? At this time, I believe it was 8.6% when the speech was given for calendar months, May. Um, so what are they going to do about it, right? And so continuing to talk about the FOMC and how they raised 75 basis points this past meeting, and then the two previous meetings, it was cumulative 75. So now we're at 150 basis points essentially, or 175. I'm sorry, at the top end, right? Because it was 0 to 25 basis points. Pretty sure was Fed funds range because that's how they do it now. It's a range. It's an effective Fed funds range rather than just a rate, right? Because they do it with kind of establishing a bottom and a top of the range with their various things, say like IOER, interest on excess reserves, or on RRP for the overnight reverse repo. And so it's kind of using their, what's the term they use? Mandated interest rates. What it, the rates that they set, right? Using that to kind of guide it rather than open market operations itself. Because as is in the next sentence, on June 1st, the Fed took a separate step to tighten monetary policy and began reducing the large balance sheet of basically the size, began reducing their security holdings, right? QT. Um, Talked a little bit about this in previous videos and kind of how it works. From my understanding, the previous time when we actually did QT, they essentially there's typically not like outright selling of the securities. It's more of just, I mean, keep in mind these are like agency mortgage-backed securities and treasuries. They're fixed income instruments, right? Some form of debt. And so there's maturity, they mature and roll off the balance sheet, and they essentially just don't replenish them, right? And so they basically just like if they're doing, say, as an example, say like 50 million are rolling off in a month, but they only want to have a decrease of their total balance sheet of 25 million, then they'd have to buy 25 million to make sure that the flow in general is a net output of their goal of 25, right? So just as an example on how that kind of works, right? And also, kind of more on the outlook specific for inflation. So based on current inflation readings, they expect an additional rate increase of 75 basis points for the next meeting and at least 50 basis points for the next few subsequent meetings as long as incoming data support them, right? So I believe, I don't remember if it's in this one specifically. Um, you know what? I'll hold on to that thought for later because I don't want to get ahead of myself and go down some rabbit hole again. But anyways, so with inflation much higher than the Fed funds rate, the real Fed funds rate is negative, right? Negative interest rates, real interest rates, I should say, even after our rate increases this year. So since inflation is unacceptably high, it doesn't make sense to have the nominal Fed funds rate below near-term inflation expectations. I am therefore, in terms of Governor Waller, or is that someone else? Bowman. Waller's I've done a few of his speeches in the past. That's why he's probably popping in my head. My bad. But she's therefore committed to a policy that brings the real Fed funds rate back to positive territory, which would be interesting, right? See if they actually get there, right? So our number one responsibility is to reduce inflation, right? And I think if I remember correctly, even Jerome Powell has stated explicitly that they're basically ignoring the other mandate of full employment until inflation comes down, right? Because you kind of have, it seems kind of, I'm going to go with coincidental that this is happening and really getting tough on inflation, specifically right before midterms. This could be a factor, could not be, but it could be the purpose. Not saying it has to be the purpose, but it would still have an effect on it, right? Because I mean, inflation to the point to where the populace knows it's happening is just not good from a political standpoint. And if you want to get reelected, you're basically shooting yourself in every limb you can by keeping inflation too high, right? To the point to where the people actually notice it. Say like at a 1 to 2% over 100 years, no one tends to really notice because it's slow enough to where even though it's compounding, it's still you basically just have those old people that are like, I used to buy chocolate bars for 50 cents or whatever. And then you're not having, like someone who's early 20s sitting there's like, oh, I remember when I could buy 5 pounds of chicken or when chicken was $2 a pound and now it's 3.5. It's kind of like that's noticeable, very noticeable. Um, Stuff like that, right? So, then goes on about the Fed's credibility. How they earned it over decades of low inflation, and that's their major policy tool. And I'm kind of talking slowly, not because it's difficult to say, but just trying to kind of formulate not really an opinion, because I wouldn't really say I'm very opinionated on that specifically in terms of the Fed's credibility, because it really depends on what you're looking or who's looking at it, right? And so you have some people who think the Fed's some conspiracy institution thing. I've heard some weird things from people trying to explain it to me, or at least their point of view. So I don't know. But and then there's others who basically think it's gospel. I don't think either's correct, but we're gonna leave that open to interpretation. But anyways, in that being credible for decades of low inflation, I mean, from kind of a personal, or not personal as in me, but like an individual's in general standpoint. I mean, why would you want general inflation for your own purchasing power, right? Yes, there's the kind of, oh, your wages are increasing too, but like we talked about it before, they're not keeping pace with inflation. And I don't believe they have in general, in terms of your kind of lower to middle income wages, right? Excuse me. There's that. And also kind of a more of a technicality on QT in general, to finish out. So, since the longer term goal of the balance sheet reduction plan is to include a Treasuries only balance sheet, it would make sense to eventually incorporate MBS sales into the plan so that reaching this goal does not take too long. My longer term goal, in terms of um, Governor Bowman, would be to get the Fed out of the business of indirectly intervening in the real estate market, right? So basically, with MBS's mortgage-backed securities, they take a bunch of mortgages, package them together, and basically securitize them, and then sell those securities off to financial institutions or whoever, and then they essentially use that as some form of collateral somewhere, somehow. That was kind of the premise, or that's kind of the mainstream belief on how the GFC really happened. Was like the subprime borrower and everyone basically starting to default on their mortgages. And the problem was those mortgages themselves were used within these mortgage-backed securities, and so basically the value of the securities, themselves, um, tanked, right? Because they were becoming insolvent is not the right term, but basically worthless, we'll say, even though it's not. But to get the concept going. Um, And so basically the problem was those were used as collateral for other things, right? But and for some reason the exact nuance in what was going on is skipping my mind in terms of what the problem was essentially where in the repo market institutions um, couldn't receive their short-term funding in terms of like overnight repo to say fund other they became essentially illiquid overnight, right? They couldn't get the funds they needed to operate, period. Became insolvent, sometimes literally overnight, right? Because of whatever happened, whatever the reason for their increased perceived counterparty risk in, say, the repo market, no other institutions would lend to them. And so they were kind of hung dry, um, so to speak. And and that's getting into kind of the back end stuff of Lehman Brothers, um, AIG, I believe. It's fuzzy on that one still. Anyway, some good books on that would be Fed Up by Danielle DiMartino Booth. She went pretty in depth with that. I did a book review on it, so that's a video on the channel as well. I'll link that one in there too. Sorry. I need to write down these links before I forget because I think of the links as I'm doing the videos. So like if I put a link in there besides like the source that I use, it's basically like I think about it because I'm like, oh, this is something I've done or something I've thought about that would be helpful for if you guys have further questions without me talking for another 30 minutes or whatever. Um, there's that one. I'll put that one in there, and that also has links, obviously, like to the book, and you can look it up. Really good book. I enjoyed it. And there was another one in here too, but I don't remember specifically. I bring that up because specific to the GFC, I believe she was already working at the Fed, the Dallas Fed, during the GFC, but I don't remember exactly when she started or if she was still in, what was the, still on Wall Street, because she was one of those, she was on Wall Street first and then went to the Fed. So there's that one. And then I'll put in Central Banking 101 by Joseph Wang. because that was a good one too, and it's more of like a basic kind of in general thing, right? To where central banking in general is really good for that one. But I don't know why I'm still sharing this. I don't need to. But anyways, we're gonna leave it there. I'll put those in the description in case you guys are interested. One for the video or two for the books. Just Amazon stuff. That's how I always buy them. Just for obvious reasons, I guess, because they're cheaper than the bookstore typically. Um, but those are really good books, especially uh, Fed Up by Miss Booth was very helpful in terms of understanding the Fed's dynamic in general because she gives very kind of personal, her personal experiences working in the Fed, right? And then Central Banking 101, Joseph Wang was, I believe, the head or whatever they call the leader, whatever, on the trading desk at the Fed. So he was the one who was actually like in charge of QE, of buying the treasuries and stuff like that. So it's like that's a when it comes to that kind of thing, it's like he's the one who actually did it. So it's like he probably an opinion you want to listen to, or at least a voice you want to listen to. That's how I thought about it. And he was also very helpful in kind of understanding specifically like the shadow banking system, or at least kind of from a general point of view, and also the Eurodollar system, because those were two things that I wasn't sure how they kind of meshed together at first, and then kind of him giving like the basics overall really helped. But hopefully those are helpful as well. But anyways, I gotta go make dinner. So um yeah. Anyways, I'm gonna leave it there. So I'll see you guys on the next one.